Good to see the markets on the mend and showing a little life last week. It's actually a really good week and furthering the rebound we've been experiencing here over the last couple of weeks. It's been nice to see after got hit pretty hard and kind of bottomed out in February. Markets had taken quite a dive. So again, some positive momentum last week, and we'll talk about the stories behind that. But this is your Market in Minutes report. I'm Mike Minter, Chief Investment Officer with Financial Synergies. And we're looking back on last week, of course, which was April 21st through the 25th. So let's dive into the numbers a bit here. So last week, across the board, just really good performance out of the major indices. You can see that over here. Tech stocks in particular really were the shining star last week. Nasdaq almost 7%. So a nice rebound for tech. And obviously they've been the hardest hit. So it was natural to see them kind of with the sharpest uptick in the rebound. But really great to see across the board such strong returns last week. And this just furthered the recovery on the year, because at one point, the broad market, the S&P, was down almost 19%. So we were flirting with kind of that. Whoops, sorry, folks. Sorry about that. We were flirting with that bear market territory of the negative 20% drop off the high. So didn't quite get there, but hopefully we're on the mend and this trend continues. Another bright spot continues to be international stocks. They've done really well last week, and in particular this year, up over 10%. At one point, they were up quite a bit. I think maybe 16, 17%. So good to see those diversifiers holding strong. As we look at rates, not much has changed here since the last time we reported. They've been kind of stagnant. We've been obviously hoping to see these come down more, but given the environment and the uncertainty around things this year, those rates have not come down as much as anticipated. And then, of course, the Fed is kind of in a holding pattern right now. But we suspect there will be some decreases this year. 30-year mortgage has been a little stubborn. I think most home buyers have wanted to see that more aggressively come down, but just thus far hasn't been the case. We'll talk more about housing here in a minute. Here's a story behind what happened last week. Markets opened the week lower as investors continued to fret about China trade tensions, but the sentiment did quickly shift, and stocks rebounded Tuesday following news that the administration had intended to de-escalate tension with China over the tariffs, and the rally extended through two more consecutive sessions as investors responded favorably to some reassuring comments from the administration. Markets were also encouraged after the president said he had no intention of firing the Fed Chair Powell, so that's good news. The markets didn't like that. Also liked hearing Treasury Secretary Scott Bessent's comments that the U.S. had an opportunity for a big deal with a key trading partner. So hopefully more news to come on that. Mega cap tech stocks, which had, as we spoke about in the initial opening, which had been under pressure for several weeks, they did regain momentum during the week and led the market's advance. So good to see some strength out of those big tech stocks. Talk a little bit about housing. We touched on that earlier, but fresh housing data was released last week, and it showed the median home price for a newly constructed home was $403,600, and an existing home was $403,700. So they were virtually identical in March. And this is very unusual. So typically the average new home costs more than the average existing home. But last month, the median home price fell while the median existing home price rose and actually hit a new all-time high. And I think this is just indicative of the real estate market that we're in. It's just an upside down market and has been for a couple of years. Very difficult market for new home buyers coming in. Rates are still relatively elevated. And for those existing homeowners, kind of sitting there on a 30-year fixed rate at, could be as low as 3% or even lower potentially. It's hard to let go of that. So we've been in this kind of stalemate with buyers and sellers, and And so we need that to loosen up a bit. So hopefully as rates come down or maybe some more inventory comes on the market, things will start to loosen up a bit. But thus far, housing does continue to be a sticking point, a real kind of sore spot. What's on deck this week? Got a lot going on. Key economic data here on the left. Tuesday, we got trade balance and goods, retail and wholesale inventories, Case-Shiller home price, consumer confidence, job openings. Wednesday, we have GDP, ADP employment report, pending home sales, and personal consumption and expenditures index. Thursday, ISM manufacturing, construction spending, and auto sales. Always like to pay attention to auto sales. Friday, employment report. That's a big one. And factory orders. We are in peak earnings season, as you can see over here to the right. Fever pitch. I will not go through all these names. There's a ton of them on here, but what you'll notice is a ton of big tech names in here. So, for example, Microsoft, Meta, Apple, Amazon. So a lot going on here. Also some big energy names. So just across the board, this is a big, big week that Wall Street will be paying very attention to these earnings reports coming out. I will leave you with that. Here is our contact information, folks. If you need to get in touch with us for any reason, we'd love to speak with you. Hit that subscribe button down below if you haven't before and get all our videos as they come out. Beyond that, I will leave you with some light disclosures here. Folks, we will report back to you next week on what we find this week. Hope you have a good one.